Welcome to a midweek market brief special. I'm Caroline Woods, and I'm joined by Jeffrey Currie, Global Head of Commodities Research at Goldman Sachs. Jeff, great to have you with us.
Great, thanks for having me.
All right, speaking about oil prices, what's behind the latest run up that we've seen? I mean, it only really puts a dent in the historic fall, and prices have reversed course a bit, but there seems to be a new burst of optimism in the energy sector.
Well, I think the key reason really is that the rebalancing now is in the line of sight. We're not there yet. I want to be careful there. But the point is, by the end of this month, we're likely in an environment where demand finally exceeds supply. It's not that demand's going to pop up and be immediately above supply. It's more that supply is edging down due to hitting infrastructure constraints, the OPEC production cuts due to financial stress in the system. Demand is beginning to improve. And so what the market is trying to trade ahead is this idea that we can actually visualize, see a light at the end of the tunnel and a rebalanced market.
The big question then, I guess, though, is how long does it take for the glut of supply to be alleviated?
Oh, that's the real question. That's going to take a while. When we think about the glut, we likely added somewhere around 1.1 to 1.2 billion barrels of oil. That's a lot of oil in storage that needs to be drawn down. And the way you can think about it is it'll come in three different stages. The first stage is to draw down the very expensive floating storage, that's sitting in tankers around the world. We think that will occur in the third quarter of this year. We'll take down somewhere around 450 million barrels of oil in the third quarter. As we get into the fourth quarter, we think you'll start to work on the on-land storage, which is lower cost to carry. That's working up that supply curve. We think you'll take out another 400 million barrels. But don't think supply is going to that you're going to see a sharp ramp up in prices, because what's likely to happen here is you need to keep prices down into that $30 a barrel range on a Brent basis to keep that supply from coming back in the market. Because the minute the supply comes back in the market, prices will come crashing back down again.
So, I guess what's the biggest factor that could move oil prices right now?
At this point right now, they're probably trading at the high end. You listen to what the companies said. They said you get into the low 30s. They're willing to start to think about bringing back on production. But I think the key verbiage they used was a sustained price. The pop up today is not a sustained price. I think that the key point there is if you get too much higher from these levels, you'll start to bring on incremental supply. And if you do that, we're right back into the same problem we had before. Because when we look at the demand trajectory, yes, we're seeing it improve. And yes, we think it's V-shaped, but it's going to take a while. The overall demand loss is somewhere around 19 million barrels per day relative to a peak demand loss of 30 million barrels per day back in the middle of April. So yes, it's a better environment. However, the average in the month of May is going to be down 17, and then down somewhere around 12 when we get out to June and July. It won't be till August that we're down somewhere around 5 to 6 million barrels per day.
If the demand looks more like a V, what does the supply shape look like?
The key issue in some of these markets, particularly oil, the supply is likely to be L-shaped, and that's creating that wedge that ends up drawing inventories. And there's several reasons for that. One, potential damage you do when shutting in the wells. That could, sometimes you might need to refrac these wells, and that can take weeks. But the big one is there's natural decline rates to oil. It is an organic deposit, and if you're not investing, you have a natural decline rate, which means you need to spend a lot of money to bring up the production. Which brings me to the third issue that's critical is access to capital. Balance sheets have been severely hurt right now, and the investors are not interested in giving this sector a lot of money. Therefore, they're going to need higher oil prices to be able to spend to be able to bring supply up again. So I think the key point here, which what creates a bullish oil environment when we look out 12, 18 months, is the inability for supply to respond quickly here.
Just finally, it seems like you're saying there's light at the end of the tunnel, but not necessarily out of the woods. Is the worst of the demand destruction behind us? And I guess, are we still having to worry about bankruptcies and companies going out of business or negative oil prices right now? Is that behind us?
In terms of looking at the pressure on the industry and the financial stress in the system, that's unlikely to go away anytime in the near future. Because the only way you get to a point in which the system is completely out of the woods, you need prices back up into those low 40s or above those levels. At that point, you take the financial stress off the system. Our forecasts don't have that happening until we get into the end of this year and into early 2021. Again, going back to that point, you need to keep the supply off the market because demand is still weak and we need to see the rebalancing in terms of drawing down those inventories.
Jeff Currie, really appreciate you joining us. Thanks so much.
Thanks for having me.